And we're going to go with Apple in a minute, but we've got Jim in Palm Harbor, so we're going to go to him. How you doing today, Jim?
Doing good. How are you?
Fantastic. A little cold,
That's
though,
great.
here. You're in Palm Harbor. I'm sure it's probably a whole half a degree warmer than down here in Clearwater, but I'm feeling a little brisk.
yeah, it's been really cool. I was outside just a little while ago. It's trying to warm up a little.
Yeah. Well,
uh,
anyway, I always love this time of year when it gets to be 60 and everybody starts freezing and their teeth are chattering and people are up -10 up north. And it's everything's relative. Anyway, what are
yeah,
you thinking about the
it is.
S&P?
Yeah, well, if the question is actually on the 50-day and 200-day moving average, the so-called death cross. The S&P's that way on the daily. Amazon recently crossed over 50-day over 200-day. And you heard a lot about the death cross, and I haven't heard anybody really talking about the death cross. And I was just wondering your opinion on that.
It doesn't really mean much. I did
Okay.
one of the things is that's one of the easiest things to test with a spreadsheet, much less setting up a database and actually testing what happens in it. There are some small bounces in actual moving averages, but there's a great book if you want the scientific reason why I don't spend a lot of attention on moving averages. A great book called Evidence-Based Technical Analysis. And I really like the book because, one, I wrote almost the exact same book in 2003 or 4 because I got it really into going back and testing everything people told me. And I'm glad I didn't actually write the book because this guy gets all kinds of hell on Amazon for people that want to believe in something that they cannot prove, which is easily and infinitely testable. You get some
Mhm.
small spikes, but I think the small spikes in the data for moving averages is probably easier to attribute to a self-fulfilling, not fantasy, what do you call it? Self-fulfilling
Prophecy.
prophecy, right? So I just don't,
Right.
I don't think a great deal about those. Now that me saying that, if you can get a wisdom of crowds things going on something like that, you can make something out of it. In fact, I'm going to be doing a webinar on the 16th of January where I talk nothing about my sector oscillators, which are which you basically tear apart the ETF, look and see how all of them are doing. Basil does the 9-day uh, moving average, and I don't think there's anything magic in the moving average. I do think that there's something rather magic opposed to all other moving averages, and that is it's more of a ballistic curve. It takes a little while for everybody to get back in a selling mood and a lot of people to get back in a buying mood. And I suspect that it's so short that what it does do is kind of mimic human emotions on when you want to buy and sell. So I'm kind of a bigger fan. If you test those, they test much better. Your likelihood of making money is much better on a 9-day moving average than a 50 or 200 and all the crosses that come in between them. But to me, even a 9-day moving average is why it may be 3 or 4 times more significant than a 50 or 200-day moving average for actually making profit. It's still pretty small, so I've kind of put those all together. So let's say that you have all the stocks in the Russell 2000. How many of those are above the 9-day moving average and how many are below the 9-day moving average? If you get enough people all together, you'll probably get a good representation. The problem is using a single 9-day moving average in a vacuum or a 50 or a 200, in my opinion. If you're going to use one, probably the 9-day seems to be the most useful, and you can fairly well prove it in comparison. But again, I think that's more
Yeah.
of just a ballistic issue. There may be other ways to look at data like that and just look at the very short-term trend. But to
Yeah,
me,
I've
go
used
ahead.
the 5 and 10 days before like that.
Yeah.
But
Anything.
I just remember for years you kept hearing about death crosses and golden crosses and stuff.
The reason you don't hear any more
I just
about
haven't
it
heard much
is
about
because
it now.
it didn't work. Everybody went broke that lived and died with it. You will almost never hear long-term traders actually talk about moving averages for the most time. They just eventually they kind of give up on it because it doesn't do you any good if you get stopped out before the averages start working. What I was going to say though is in that evidence-based technical analysis book, if you want to see the scientific reason for it, it is that a moving average by its definition is going to be 90 degrees out of phase to the signal it's trying to take care of. So
Right.
by definition, if you go long enough, like 50 days or 200, it's just going to be wrong 50% of the time. It's just always going to be out of phase. You're going to be right half the time, wrong half the time. And there's some sufficient lag to when those things actually start moving. But again, everybody's got their own opinion. I can tell you, though, that if you get a spreadsheet out or write your own software, it's fairly easy to test. So you can just get all the stocks in there, put them in there, and see how well they do, and test a lot of stuff. A lot of stuff that everybody tells people that works. A lot of stuff is testable, and I won't use anything unless I've tested it. Now, a lot of times I suspect that people that use 50 and 200-day moving averages are putting something in of themselves, i.e., it's a Rorschach test, and maybe they're just great traders, and they know when and not to when to use some of that stuff. And they may just be, it's not that they're using the 50 or 200 days for a lot of stuff, and they're successful. It's that they use their own discretion. And, sometimes it's right and sometimes it's wrong, but they kind of backstop it. But any kind of mechanized system that use 50 or 200 day, you can write a Monte Carlo simulator, pretty much prove how by itself it's not that effective.
Okay.
Does that answer
I
it?
appreciate it. I knew you didn't use moving averages. I've watched you for a couple of years now, and I really enjoy your program and some of the humor you have.
Most people don't get my rather dry, sarcastic humor, so I appreciate it.
I definitely do. It's very funny. And,
but anyway, no, I was going to say that to me, the best thing I've ever found is like yesterday. We'll be back in a second if you want to hang. Where are we at here? Jim from Palm Harbor. I was just going to say, I went through probably everything that anybody's listening to me now ever did. And I kind of settled on one thing, and there's many ways to skin a cat in the market. I used to think that there was only one way, and that was a little bit of my own hubris since I had some fairly early success. But I kind of settled on one thing, and that was because it was easy and I didn't have to make a lot of guesses in it. And that was that I love going out here and just looking at stocks that test previous lows with light volume because ABCs, a lot of other stuff I had problems with. Not that it doesn't work, but I was probably introducing too much of my own biases in it by just waiting for stocks that tested previous highs and lows on significantly lighter volume. I took a little bit of my bias out of it. So I tend to trade a little bit more from the bottom of a range to the top of a range, just because I know if it went to a certain price at whatever it was, I was going to bring something up. Oh, we talked about Angie yesterday. You're still there, right?
Right.
Okay. But I mean, for me, if I see something like Angie's list yesterday, even if I hate the stock, I see that the last low was 1.2 million shares And on the December 10th, it was 730,000 shares. I know that 500,000 reasons less that it's probably going to go lower. It may not go a lot higher, but at least I want to start there instead of on the death cross and everything else. Again, to me, a lot of it's price and volume. And as I continue to see, in fact, I probably can bring it up here. To me, where is it? I put it in Everyday's newsletter. But to me, a great deal more of the market is just how much volume is. And I talked about that. On the 6th, we had 10.6 million shares, or excuse me, 10.6 billion shares, 8.9 billion shares on the 7th, 8.6 billion shares on the 10th. Yesterday, we just had 8.1 billion shares. So volume is shrinking each time the market kept on pushing lower. And to me, now we're probably going to see, you know, the market bounce, and at some point the volume's really going to fall off and tell us where the top is. But to me, instead of all these other lagging indicators, I kind of have about 1 day lag in, you know, what the volume is for the day and what stocks test the lows on lighter volume. But on a 50-day moving average, I would still probably be either lagging the signal by maybe 10 or 15 days, which is just too much for me. So, you know, if you have a long enough time horizon, maybe you can use 50 and 200 days. But for me, I don't want to be on the wrong side of the stock just that long.
Yeah.
So I don't know, what kind of trader are you? Are you trading ABCs or day trading or intraday or?
Mostly I'm intraday or to maybe like a swing trade occasionally, and anything from a day to a month.
Okay. I was just wondering, for me, I was a very short term.
I don't really use the 250 day. I was just curious because I had noticed that they had crossed, but and I just remember several years ago, it seemed like a lot of people always talked about that when it happened as a bad omen or something. And
yeah, and it never came to fruition.
I mostly trade short term stuff, and
yeah, to
I use
me,
the RSI some and HMA, and I take a. What I like to do is I like to take a MACD chart and put it on 1939 and 1, and then another MACD chart on top of it, 3, 14, and 7, and use an HMA period of 14 superimposed upon the MACD of 9 and 39, and use that as a source, as the PPO, as a source on that, and it works pretty good. It gives me an indication of getting in and getting out.
Okay. Well, I'm kind of a little bit different than you in that I try to go for somewhere between a 14-day or longer trade if I can get it. So a lot of times they turn down to 5-day trades, but I don't try to do anything on a daily basis. And so my experience may be a little bit different than other people's experience. You might find 50-period moving averages during the day more effective. I don't look at anything other than the close of day data. So I'm not looking at any kind of intraday data. I kind of look at it myself and then go back. But, you know, to me now, the biggest factor that I can find that I can test is, or the two biggest are end-of-month fund buying and expiration on monthly options. Both of those have a fairly decent 1.5% bias during that time period. And, you know, so I look at options and I look at the calendar a lot more than anything else. And so let's say that we continue to go back up to the 21st of December for the options expiration. Then we're a handful of days we're off on vacation anyway, and then you get back at the first of the year, you get right back into fund buying. And as far as I can tell, nobody's turned off their 401ks. and that money continues to come in. To me, this kind of nice setup, if we continue to move higher, this says that, you know, if you were looking and thinking the market's going lower, I still suspect that after fund buyings over the first day or two of the new year, that is when you want to make your decision on probably go short next. On options, I said I was going to talk about that today too. I mean, there's a fairly good indication that the SPYs, or at least options, are looking at 280. Now, after today, that may pull back, but we've been showing about 275 to 276 for about 4 days, and no one ever blinked an eye on the market makers. Normally, if the market is going to go lower, they'll continue to sell that off every day. Just the opposite happened. They started moving the projection for what options should be on expiration up. And that's kind of the thing that tipped me to being long the last couple of days.
Yeah. Yeah, I saw the bounce coming here. I wasn't sure how long it would last.
Well, you don't know, but I'm going to assume that it lasts through at least the 21st. Just about every kind of thing that I can find as a scenario makes it better. And at the same time, I understand the idea that weak markets are available, but like I said, I'm going to be looking the 2nd of January or 3rd of January to see if that market's weak. At that point, I think you can make a much better case for being bearish than you can today. Thanks for the phone call.
I appreciate it.
Be back in a minute.
Thank you.